Welcome back. You're still tuned into Power Breakfast. It's time to talk about some key earnings. SBI reported its first quarter numbers over the weekend. Ritu is joining us to give us the fine print and the analysis of the numbers. Good morning, Ritu.
Good morning, Sona. SBI's first quarter numbers were a tad below the CNBC-TV18 poll. Profit growth was flattish at 0.9% over the previous year, and this is because of an erosion in margins. There was a dip in other income as well, and a sharp rise in the loan loss provisions, while the core income of the bank, net interest income, that grew by 5.7% over the previous year. Sequentially, there was a decline in both. Now, margins saw a dip of about 8 basis points on a sequential basis to 3.22% as the yield on advances dropped, while the cost of deposits was more or less flat, but the drop in NIMs was offset to some extent by the rise in investment yields. If you look at the asset quality, though, while the ratios, gross NPA and net NPA, they were stable or even improved, the gross slippages were sharply higher at 8,707 crores versus about 3,900 crores in the previous quarter. But the management attributed most of this to seasonal and one-off factors which should rectify in the coming quarters. The advances growth was good at more than 15% over the previous year. Sequentially, it was muted, no surprises there. But deposit growth at just a little over 8%, year on year, that was sharply below the system level growth, which is at 11% plus. In terms of guidance, the management expects to see credit growth of about 14 to 16% for the year, defend margins at the current levels while retaining the cost of credit at around 0.5% for the full year. Take a look at what the chairman Dinesh Khara said on all of this.
I hope that we should be in a position because whatever increase in deposit rates have also happened, even our MCLRs have also gone up of late, and we will be in a position to have the better yield on advances. Our yield on advances have already moved to about 8.86%, and we should be in a position to improve our yield on advances going forward. So that is something which will help us in ensuring that our NIM, we should be in a position to protect around these levels. We are having a pipeline is about 4.76 trillion, and it is equally split between proposals in pipeline and also proposals which have been sanctioned but awaiting disbursement. So I expect that, of course, when it comes to these corporate proposals, the disbursement takes some time. It does not happen immediately. But yes, of course, a significant portion of that, at least part of it, will be availed. This is what we expect. So I think I expect that we should be in a position to maintain our earlier guidance of about 14 to 16% kind of a growth and more towards 15% kind of a growth. As I mentioned, that these are all temporary aberrations. That is something which has caused these slippages, and I don't expect that it will have any permanent impact on the book. And all the subcomponents of the book are faring well, and we have actually seen that SMA 1 and 2 as compared to previous year have also come down from over 9,300 in the first quarter in the previous year. It is now somewhere around 7,900 odd crore. So that is something which we have seen. So I think it's a very clear reflection that when SMA 1 and SMA 2 are much lower, that asset quality is not a challenge. And also, if at all you will look at the slippage ratio, it is actually 10 basis points down as compared to the first quarter of the previous year.